Since I first bought the trade desk stock, it is up over 10 times. However, it has been anything but a smooth ride. As you can see, over the last 3 years, it's been a terrible roller coaster. It's actually underwater over the last 3 years. And zooming in a little more recently, you can see year to date, the stock has lost more than 50% of its value. Does this mean the trade desk is suddenly, going out of business, or what's going on with the business that it would lose half of its value? Because losing half of its value in such short order usually is some sort of red flag. So let's dive in to understand what's going on here with the trade desk. Fortunately, as I'll talk about throughout this video, it's been a while I've owned it, and it used to be a much larger percentage of my portfolio. For the last few years, it's been under 1% of my portfolio, just because of some of the dynamics that we're going to talk about here. Predominantly valuation is the key aspect that we're going to talk about towards the end of this video, thinking about, where does the stock potentially go? So what do they do? Why is the stock down? Where are they potentially going in the years ahead? We're going to cover all that in this video. My name is Daniel. You're watching Unrivaled Investing. If you enjoy educational investment content, I do appreciate you hitting that thumbs up, hit that subscribe button. So let's dive right into understanding what is the trade desk, or TTD Stock. And so what they do, they are a platform for ad buyers. What does that even mean? So you see a lot of different logos on here. The thing to focus on is that there's a lot of players. You have advertisers that are looking to, talk about what they're selling or talk about a good or service. They might have an ad budget, billions, trillions of dollars over time. And what do? Well, they say, yeah, we don't really know what's the exact message that we want to say. So they hire an agency. There's a lot of different agencies out there. The agencies say, yeah, we can come up with a message for you, but we don't necessarily have the technological know-how to interact with all the different pieces, because there are ad exchanges, there are supply side networks, there are the publishers that have the inventory or have that space that you can market on. But how do you intelligently do that? And that's where you go to a demand side platform like the trade desk. And their appeal is that they are empowering the advertisers, the agencies, to intelligently purchase ad inventory in real time. The way management has described it for the better part of this past decade, it's very much like the stock exchanges, where you zoom out over the last few decades, it was an open outcry system, people yelling, oh, I'll buy this, I'll sell this. And that was how, exchanges and the transactions occurred on the stock exchange. But now it's perfectly quiet because you have a bunch of servers running, a bunch of computers talking to each other. That's where you're going with advertising. That's where it's been going. And it's about programmatic. So about sort of these algorithms bidding on, what do we think we can get the best return on investment spend in terms of this advertising dollars. So that's what this demand side platform, working with these agencies and advertisers and figuring out where do they want to spend the money. And you're talking about a sizable opportunity, roughly $1 trillion opportunity. And, when you see how much spend is going through the trade desk, which is roughly $12 billion versus, let's say, $1 trillion opportunity, you know that there's a lot of room to run. And this has been one of the reasons why I originally bought it and why I still have a very small position, under 1%, is because this track record of consistently taking market share. When you're saying, yeah, we're growing at 20% plus per year, that does suggest to me, in my opinion, if the market's not growing 20% and you're doing something special. That's a green light. That's a signal to me as an investor. I'm looking for unrivaled companies. I want those types of companies that are growing faster than their market. That is a signal you're doing something special. And seeing this level of consistency, doing something special, growing year in, year out, that's a very good signal, in my opinion. And you can see they even did it during COVID, growing nice, the spend grew quite nicely. And so year in, year out, revenue has also been tracking higher. And one of the key aspects of why I actually originally bought it was because not only have they been quickly taking market share, but they've also been profitable since 2013. Now, a lot of those profits have been reinvested the last few years, but seeing profitability from the beginning is something I really like to see. Now, I oftentimes hear, the sort of pushback, aren't you worried about Google, Meta, Amazon sort of going after, their business, this demand side business? And I'd argue that there will be a niche for them. And this is, their main talking point as well, which is that all of these other platform providers, whether or not you're an Amazon or Google, they oftentimes have their own inventory that they're looking to sell. And so they're conflicted. Whereas here, they don't have, the trade desk doesn't have inventory they're looking to sell. They're aligning themselves with the brand, with the agencies. So there's no conflict of interest to find them the best deal in terms of where they should spend their ad dollars. And another key aspect that originally attracted me to the trade desk was seeing Jeff Green, who effectively has control over the company. And, thinking about him, he is, a founder, CEO. I love to see founder, effectively operated businesses. They take pride of ownership. And then he also, this isn't his first rodeo. He previously had another company that he sold and, made a boatload on. So when I see a founder that doesn't need to do it again, but they're doing it again, then I'm like, oh, okay. They have a track record of creating value for shareholders. He doesn't need to do it. He could go, beachfront property and enjoy himself. But he's doing this because he sees something. He sees an opportunity. He's excited about it. So generally, that, in my opinion, is a higher probability situation when you have that type of alignment with management. You go, okay, I want to align myself with a person that doesn't need to do it, but they're very passionate about it. The missionaries versus mercenaries aspect. And so thinking about the investment highlights, they do a great job summarizing it. They're crushing it, growing at a good clip in 2024. They're talking about significantly free cash flow generation, around $700 million in free cash flow, huge market opportunity. Their fastest, sub-market opportunity is connected TV, which is growing very quickly. They see a lot of opportunity for international growth, and that their objectivity is one of their greatest assets because it aligns themselves with the brands and the agencies. So they believe, look, this is a great company, great opportunity, and this is an investment. The trade desk is an investment in an open internet, not the walled gardens like behind Facebook. And so why is the share price collapsing if the thesis looks so great? And so I think it comes down to Charlie Munger, where, tying it back to basics, where, he once described investing as the equivalent of going out and betting against the pari-mutuel system, where he says, we look for a horse with a 1 chance in 2 of winning, and that pays 3 to 1. In other words, we're looking for a mispriced gamble. I think this is very relevant because a lot of investors, say, oh, this is such a great company. The opportunity is so obvious. And that was the challenge, is that everyone knew, like Charlie Munger was just talking about it at horse track racing and betting, which is that if everyone knows you have a great horse and everyone's betting on it like it's a sure thing, the odds and the payout just become a lot less attractive, such that you get into a situation where if everyone says this is an amazing company and the valuation says, yeah, it's not only amazing, it's amazing plus, then you can get into a situation where the stock goes nowhere for years. And then you can see that 50% plus haircut if there's even a whiff of underperformance. And I'd argue that is the chief reason why the stock has lost more than 50% of its value so far this year and has been treading water for the past 3 years, is valuation got absurd. If you're paying 40 times sales for a company, I wish you luck. It's not going to be easy. It's going to be very challenging to make that work out. In theory, it could, but the odds, it's always about betting. It's always about thinking about what's the base rate. There's a book called Super Forecasting. I recommend you check that out in terms of what are the base rates, meaning how do these types of bets generally work out? And so if you're paying 40 times or even 20 times plus sales, it's a much tougher hurdle. Sometimes you do get speculation that goes even crazier. But, when I personally was buying the shares, it was closer to 5 or 6 times sales. And by the way, the thesis was better because it was growing much faster. And so that is, an element for investors to think about, which is, you get bigger, generally the growth rate gets harder to keep that up. Now, I do suspect when you're talking about $1 trillion opportunity and $12 billion in spend, that there is still plenty of room for growth. But this is worth reflecting on that. Yeah, it's now probably getting closer to a reasonable valuation. And in the last few years, it was absurd. Now, another key aspect, and I would say this is minor relative to the valuation, relative to people saying this is the horse that's going to win, people betting on that, is that, their outlook for this year came in a little softer than they expected. They talk about growth for the first quarter. They don't provide full year guidance because, look, it's an advertising business, and we'll talk about that in just a second. But they did say for the first quarter, they're expecting around 17% growth. That is continued deceleration, so that is a bit disappointing for investors. And not only, sort of add insult to injury, not only are they expecting growth to potentially decelerate, maybe it picks up, who knows, but they are expecting to sort of a modest increase in their expenses, so you could have a modest deleverage. So profit margins would go down this next year. So investors don't like to hear that. You want to hear thoughts about expanding margins and accelerating growth. What are my thoughts on the trade desk from here? So first of all, this is not financial advice. As we talk about the trade desk, in full disclosure, I do own a tiny position in it. I am thinking about adding more. But also a quick plug, just yesterday, Pinkle, a premium member of the Unrivaled Investing community, shared the following. This is a direct quote. "I've been with you for a year and it was a game changer for me. Thanks for creating this service. We have an excellent community." And this follows Sam, who recently said, "Daniel, just re-upped my annual subscription after 1 year of being in the community. This subscription has paid for itself many times over. If you're looking for compelling ideas, come check out unrivaledinvesting.com. The premium subscription, by the way, the annual premium subscription will be going up later this year. So now is the time to lock in that favorable rate. So let's start with a sort of high level perspective. And I think this is, I previously did a video on recession and what works, what sort of doesn't in this environment, particularly what doesn't work. So I'd recommend you check that video out. That was in the last week or two, but I think it is worth sort of zoom out, then zoom in terms of thinking about the trade desk. And zooming out, it is important to understand that the Federal Reserve, the Atlanta branch, is forecasting a recession. And you can see that here. They are saying in the first quarter, they're expecting economic contraction. You can look at the different pieces. The pieces might suggest, hey, it's really tied to tariff activity. And then, you might see, a dramatic change in import-export dynamics. And that's the real reason why. I would argue, you zoom out a bit, if you go from a fiscal deficit of 7% to 3%, that's going to create a huge problem for the economy, and that could create a recession. That said, that's a macro forecast, that's a macro expectation. My general view with macro is that it's too hard. It's good to be aware of, but generally you're better served buying quality businesses, focusing on what you can control versus trying to predict what you can't. And I think macro is just very, very hard. It's something to be aware of. And so if the Federal Reserve is effectively telling you, yeah, contraction, that is worth paying attention to. Another dynamic, zooming in a little bit closer to the trade desk, is that this is an evolving industry. This is not like selling, candy bars where it's the same candy bar that's selling 50 years ago that's selling today, like a Snickers or See's Candy. This is a dynamic company, this evolving industry. And you can read a full report completely for free at flash.stocksentinel.ai. And, they call out that I'm one of the co-founders of Stock Sentinel. And it calls out, look, they have this AI new powered architecture that's trying to effectively make a better product, but it's been rolling out a little bit slower than they expected. And then there's also a recent acquisition that they announced of Sincera, a data analytics company. So it is important to understand that when you're making a bet on the trade desk, you are making a bet to a large extent on Jeff Green continuing to sort of see around the corner saying, hey, how do I make sure my company keeps growing? How do I make sure we aren't disrupted in the years ahead? This is when you have an evolving dynamic like that, if you win, more props to you and, better profitability and all that sort of stuff. But it is worth understanding that with evolution, with changing dynamics, I would argue there should be more of a risk premium. So lower valuations because of that uncertainty. Does something go awry? Does some sort of competitor, disrupt you? So far, I'm not really seeing that, but it is worth calling out that, what they look like 5 to 10 years from now will be different than today. Going through this checklist, and this is, zooming in on the micro aspect of this, and this is the same checklist, whether or not you're looking at a penny stock or a $1 trillion company, that I think it's very relevant to use, which is that, do you have aligned management? I think you're there. Yes, there's been a lot of insider selling over time, but still, this is Jeff Green's baby, so I would say it's an aligned management. Compelling valuation, let's talk about that in just a second. I'm not quite sure if it's at a compelling valuation level, but let's talk about it. Next is obvious growth. Yeah, I think there is still obvious growth potential. $1 trillion market opportunity, $12 billion gross spend. Yeah, there's still plenty of growth, I'd say, in the years ahead. Blow up risks. I would say the blow up risks are it's not zero, but there are issues. I just talked about evolving industry. One customer, I think it's Publicis, that's one of the agencies that represents around 14% of their billings in 2024. The top three were 40% plus of their receivables. Now, it is worth understanding that these ad agencies, generally, they're like an umbrella company that own a bunch of marketing agencies. So it's not like one company necessarily is directing 14% of spend. It might be a bunch of the agencies underneath it that say, hey, this technology is so great, of course we're going to use it. But does create a risk. If there were a top-down sort of, you are not allowed to use the trade desk, it could create a real problem for them. And you would see significant, margin compression in that sort of scenario. I do view this as a win-win where, all the players in the ecosystem are winning because the ad spend gets a better return on invested dollar. So that's how I think about this broadly. This checks out. This is the horse that you'd think will win. The question is, are the odds, the favorable odds that Charlie Munger was talking about, where you can buy that quality horse and get an even better payout because, investors aren't really pricing in a great horse. Great setup. So looking at it now, around $56 per share, once again, down about 50% over the past few months. My view is, yeah, it's an exceptional company. Could it bottom from here? Maybe. It's certainly oversold, but I would say it's not deeply cheap. And so if you were to compound at 20% in the years ahead, and you were to get better profit margins than where they currently are, and you assume a 30 times multiple, 5 years from now, effectively, then you're talking about roughly 100% upside. And keep in mind, this is hypothetical. Of course, the stock price can go higher or lower. But when you pencil out a scenario where it's 20% growth, 30 times N multiple, assuming the free cash flow goes back to you as a shareholder, and assuming profit margins expand significantly from where they currently are versus next year where they're expecting some sort of contraction, I think it is worth understanding, some sort of deleverage. It is worth understanding that when you pencil out what you think is either a high case or a optimistic scenario, and you're only penciling out 100% upside, that it's not deeply compelling. That's not something where you go, yeah, if this works out, this is 500% upside. And this is personally, when I'm looking at a situation, I want a low case scenario. And I was just talking about in my letter this week, where my low case scenario, I would be really disappointed if this happens. And if it happens, there's still 30% upside, 50% upside, maybe even 100% upside. And I still think I would be super disappointed if they executed on that sort of vision. With Trade Desk, if they do 15% in the next 5 years, I would say that's possible. They're saying 17% in the next quarter. So, I would say it's on the disappointing side, but I wouldn't say it's like deeply draconian. And in that scenario, 20 times earnings multiple, 25 times profit margins, you're effectively still underwater over the next few years. So I look at this and also, understanding the macro in that environment, you zoom out, there were some Ruin Kniff or Sequoia Fund shareholder letters that go back to the 1970s. And they were blown away because they were buying the ad agencies, these premium companies. Buffett was too, by the way, around that same time. And, they were blown away by this is such a great business, high margins, growth potential. And, they were shocked as the multiple went from 15 times to 10 times to 5 times, maybe even lower, because there was the 1974 recession. So I think it is worth understanding that macro element does create sort of this wild card of, could you get a really low multiple for this? It's possible. I wouldn't necessarily put a lot of weight to it, but it is something when you're thinking about the different probabilities, it is something to consider for an ad business like the Trade Desk. So I look at this and I would say, personally, there are things that I find to be more compelling that I've been buying. I'm certainly not all in, but I would love to own more Trade Desk. I'm just not sure if this is wouldn't surprise me if it bounces from here, just because of how oversold, you've had all these people selling it. But there is a reset as it goes from, let's say, this is the greatest horse ever, investors to, wait a second, what's a more reasonable risk reward? What's a more sensible valuation for this type of company? When you start getting more valuation minded investors, there's that reset that's going on right now. I hope this video has been helpful for you. If so, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.